Accounting Basics. A guide to almost everything is likely a comprehensive resource designed to introduce readers to the fundamentals of accounting. Books with similar titles typically cover key concepts such as financial statements, explanation of the main financial statements, including the balance sheet, income statement, and cash flow statement. Accounting Principles. Overview of Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS. Double-entry bookkeeping. Introduction to the double-entry system, where each transaction affects at least two accounts. Debits and credits. Explanation of how debits and credits are used in the accounting process. Revenue and expenses. How businesses record income and expenses and the impact on financial statements. Assets, liabilities, and equity. Understanding the basic accounting equation. Assets equals liabilities plus equity. Adjusting entries. How and why adjusting entries are made at the end of accounting periods. Financial analysis. Basic techniques for analyzing financial statements, such as ratio analysis. Accounting software. Introduction to popular accounting software and how they can be used for bookkeeping. Here's a more detailed breakdown of each key point in accounting basics. 1. The accounting equation. 1. Assets. Resources owned by a company that have economic value, e.g., cash, inventory, property. 2. Liabilities. Obligations or debts that a company owes to outside parties, e.g., loans, accounts payable. 3. Equity. The owner's claim after all liabilities have been subtracted from assets. 3. It represents the net worth of the company and includes common stock, retained earnings, and other reserves. Example. 1. A company purchases a vehicle for $10,000. 1. If it takes out a loan for $6,000 and pays the remaining $4,000 in cash, the accounting equation will be assets, $10,000, vehicle, equals liabilities, $6,000, loan, plus equity, $4,000, cash payment. 2. Double-entry bookkeeping. 1. Debits and credits. Each transaction affects two or more accounts. 1. Debits and credits must always balance, meaning the total value of debits must equal the total value of credits. Example. If a company buys $1,000 of supplies on credit, it will debit the supplies account, increasing assets, and credit accounts payable, increasing liabilities. Accounts are categorized as 1. Assets. Debits increase, credits decrease. 2. Liabilities. Debits decrease, credits increase. 3. Equity. Debits decrease, credits increase. 4. Revenue. Debits decrease, credits increase. 5. Expenses. Debits increase, credits decrease. 3. Financial statements balance sheet. 1. Shows a company's financial position at a specific date. 2. Assets are listed on the left, or top, while liabilities and equity are on the right, or bottom. 3. It must always balance. Assets equals liabilities plus equity. Income statement. 1. Covers a period, e.g., month, quarter, year. 2. Revenue, sales, is reported at the top, followed by expenses, cost of goods sold, operating expenses. 3. The difference between revenue and expenses is net income, profit or loss. Cash flow statement. 1. Divided into three sections: operating activities, cash from core business operations. Investing activities, cash used in or generated from investments in assets. Financing activities, cash received from or paid to lenders and shareholders. Example. 1. If a company generates $100,000 in sales, incurs $60,000 in expenses, and has $10,000 in tax obligations, its net income would be $30,000. 4. Recording transactions journal entries. Transactions are first recorded in the journal as they occur. Each entry includes the date, accounts affected, amounts debited and credited, and a brief description. Ledger. Entries from the journal are posted to the ledger, where they are categorized by account, e.g., cash, inventory, accounts payable. Example. 1. A company receives $5,000 from a customer for a previous sale. 1. The journal entry would debit cash, increasing assets, and credit accounts receivable, decreasing assets. 5. Adjusting entries purpose. Adjusting entries ensure that revenues and expenses are recognized in the correct accounting period, following the accrual basis of accounting. Types of adjusting entries. 1. Accruals. For revenues earned or expenses incurred that haven't been recorded yet, e.g., unpaid wages. 2. Deferrals. For cash received or paid before the revenue is earned or the expense is incurred, e.g., prepaid rent. 3. Depreciation. Allocates the cost of a tangible asset over its useful life. 4. Amortization. Similar to depreciation but for intangible assets like patents. Example. 1. A company pays $12,000 in advance for a 1-year insurance policy. 1. At the end of the first month, it will record a $1,000 insurance expense and decrease prepaid insurance by the same amount. 6. Financial analysis. 1. Liquidity ratios, current ratio, current assets, current liabilities. A ratio above 1 indicates that the company can cover its short-term obligations. 2. Profitability ratios, net profit margin, net income, revenue. This ratio shows the percentage of revenue that becomes profit. 3. Leverage ratios, debt to equity ratio, total liabilities, total equity. It shows how much of the company is financed by debt compared to equity. Example. 1. A company with $200,000 in current assets and $100,000 in current liabilities has a current ratio of 2:1. This suggests good liquidity, as it has twice the amount of assets to cover its liabilities. Summary: understanding these accounting basics provides the foundation to interpret financial information and make informed decisions. Whether managing personal finances, running a business, or advancing in a finance-related career, mastering these concepts is essential.